This is Nightly Business Report with Tyler Matheson and Susie Garrett.
Bad end to a rough week. The Nasdaq closes below the key 4,000 level, and the S&P has its worst weekly drop since June 2012, leaving many investors wondering whether the bull market is still intact.
Big miss. JPMorgan, the first major bank to report earnings, disappoints. What's hurt the firm's bottom line in the first quarter, and will it continue into the second?
And the crisis widens. New General Motors documents raise questions about what CEO Mary Barra may have known about some of the recalled cars. We have all that and more tonight on Nightly Business Report for this Friday, April 11th.
Good evening, everyone, and welcome to the support group. We invite you to sit down, have a soft drink or something maybe a little stronger, and reflect. What has happened to those lovely stocks that went up 30% last year? Why have those shares that loved you so much in 2013, like Netflix and Facebook and Amazon, turned a fickle, cold cheek to you now? We'll explore that in some detail tonight, though I can't promise any definitive answers. A few weeks ago, at least we had Crimea or China or Yellen to point to when the market wilted. But for these past several weeks, including this one, the worst for the Nasdaq and the S&P in nearly 2 years, there has been a dearth of headlines to move stocks. Maybe it's just momentum in reverse. Those momentum stocks went up uninterrupted for seemingly little reason when they rose. Now they're falling just because they can. You're forgiven if you'd rather avert your eyes as we look at the numbers. Cover your ears, too. The Dow fell in under 143 points, closing just above the 16,000 mark, suffering its first weekly loss in 4. The Nasdaq, which was actually higher shortly after the opening bell, fell hard, down 54 today, closing below 4,000. Tech-heavy Nasdaq now down 6.5% in 3 weeks, biggest 3-week decline in 2 years. The S&P down 17% today, seeing its biggest weekly drop since June of 2012.
Well, our market monitor tonight is calm and upbeat and says investors should not be scared off by all the selling, and he's actually advising them to buy high-caliber stocks. He's Jeff Sott, Chief Investment Strategist with Raymond James. And we're so happy, Jeff, that you're here on the set with Tyler and me to talk about all of this stuff. So you're in New York this week. You've been talking to clients, institutional clients, and you're telling me that they've been pretty anxious about everything going on, and you're so upbeat. What's the disconnect?
Well, it depends on who you talk to. If you talk to the portfolio managers that have been, playing the Netflix and some of the high beta stocks, there's some angst out there. But if you're talking, I spoke at the Tiburon CEO conference Tuesday morning, and I rode back in Ron Barron, who's one of the better investors of our lifetime, in a car for an hour and a half trying to get back to Midtown in the rain. And he was like Warren Buffett, in '74, a kid in a candy store. A lot of these stocks that have come down dramatically have given you a chance to buy the dip for the first time since, I'd say, June of 2012.
High-caliber stocks. I feel more this week like a high-caliber weapon to use on myself. My portfolio has taken such a hit. But there has been a move from some of those high-beta stocks into, let's just say, some of the bigger blue-chip technology shares. Microsoft at a multi-year high. IBM went up this week. Cisco doing just fine. Intel. Is that what you're suggesting, those kinds of companies?
I think some of those are okay. I think some of the others are value traps over the long cycle. But in a low-growth environment, I think that Wall Street will pay up for true growth. And some of these stocks that have come down 30 and 40% that are true growth stocks, I think will come back. Now, we came
Like what? Like what? They'll come back 30 or 40%.
Well, I mean, there's a in the healthcare group, there's a company called Dexcom that makes the best wireless glucose blood monitoring system on the planet. The stock was $50 a share, what, Susie, a month ago, and it went into the low 30s. Now it's trading around 35, 36 right now. They just got approved for their infant product to monitor infants' blood glucose.
Well, let's talk about some of your other stocks, because you have a couple, and there is actually another healthcare stock, Johnson & Johnson, that you like. I mean, what is it? What's the attraction there?
Well, in a low growth environment, and I think the GDP growth is going to nestle somewhere in the next couple of years between 3 and 4%. Wall Street will pay up for true growth stocks. They tend to be clustered in technology and in healthcare, both of which are trading one standard deviation below their historic mean valuation levels. And so a name like Johnson & Johnson has a decent dividend. You've got a AAA balance sheet. They've got a nice product portfolio. And I think at this time next year, you'll have a 9% free cash flow yield on on J&J, and that makes it pretty cheap.
Real quick follow-up on that. You know, we saw this week a lot of healthcare stocks, a lot of pharma companies, biotech were being sold off, but this is different.
This is different. This isn't a biotech, play. If you're looking for a biotech play, I would take a look at Bristol Myers. Bristol Myers has a very robust biotech division. They're one of the leaders in what's known as PD-1 technology or P-L-1 technology. It's a lower conservative way to get into a pretty good biotech pipeline.
You like a couple of mobile phone tower operators or builders too.
Yeah, again, this is the technology theme. Technology sector has a 21-22% ROE, whereas the S&P has a 15-16% return on equity. And one of the big themes we've had for the past dozen years or so is mobile computing and the convergence of devices. You can see it every year that your mobile device is becoming your computer. And if you don't have the connection, it doesn't work. So the tower stocks are a second derivative play on mobile computing and the convergence of devices.
All right.
All right, we'll have to leave it there. Real quickly, any disclosures on the stocks that you mentioned?
I own Dexcom.
Oh, okay. All right, thanks a lot. And real quickly, before we go, next week, which direction you see the market, up or down, in a few words?
I think you're building into a selling climax. I think it probably happens next week.
All right.
Well, that's
Jeff
definitive.
Sott, thanks so much. Have a great weekend. Jeff Sott, Chief Investment Strategist with Raymond James.
And talk about a tale of two lenders. JPMorgan Chase was the first Dow component to report first quarter earnings today. And then out with results came rival banking giant Wells Fargo. Profits at JP fell by 1/5, sending shares down more than 3.5%, making it the biggest decliner in the Dow. Net profit at Wells Fargo topped more than $6 billion, while shares rose nearly 1% on a very down day in the markets. Kayla Tausche has more now on what's behind those disparate earnings results.
JPMorgan Chase, the biggest U.S. bank by assets, first out of the gate with earnings and the fortress business model showing some cracks. The bank had two distinct culprits, a sharp slowdown in mortgage underwriting and an equally sharp slowdown in trading, one that could continue through part of the second quarter. Those issues adding insult to injury in an economy with weak loan growth and less corporate activity than expected. Eventually, loans will grow and yields will rise, strengthening the financials foundation. But FBR's Miller said they counted that income too soon.
We were afraid that a lot of these banks were running up on expectations of a great economy, expectations of higher rates. Now you're seeing rates drop.
Wells Fargo, one of JPMorgan's fiercest rivals, saw its other businesses sidestep that issue. The San Francisco-based mortgage lender relies less on trading than peers and saw better credit improvement, two facts that led Wells to beat expectations and have double-digit earnings growth, a tough feat. Wells Fargo aims to grow its mortgage business by moving to lower credit and higher yielding borrowers, something JPMorgan, scarred from recent legal battles, refuses to do, even though the market has few options for home buyers without GSE support or sterling credit.
A lot of people have overlays. They're being tougher than is required by FHA, GSE, or their own rules because of reps and warranties, et cetera, and I don't know when that's going to go away. It's not getting worse. It's just kind of sitting there and probably holding back a little bit the purchase market.
JPMorgan's risk aversion has affected other lines of its business as well. Its clearinghouse refused to process a payment from Russia's embassy in Kazakhstan, citing sanctions, and it ended management of a college fraternity's bank account as well to guard its reputation. All of that just in the first quarter. The bank clearly sacrificing growth for its long-term reputation. For Nightly Business Report, I'm Kayla Tausche in New York.
David Hilder joins us now to discuss today's bank earnings and what we can expect when other big banks report next week. He's senior banking analyst at Drexel Hamilton. David, good to have you with us. Let's start with JPMorgan and Wells Fargo, the two banks out today. What did you make of their results, and are they buys, sells, or holds in your book?
Well, Tyler, thanks for having me on. I do have buy ratings on both Wells Fargo and JPMorgan. I think what we saw in the market today was a little bit of money flow out of JPMorgan and into Wells Fargo simply because Wells Fargo reported better than consensus estimates of earnings, and JPMorgan fell a little bit short. They're both very good banks. They're certainly making a lot of money. They're both in great capital positions. I think to some extent the first quarter is viewed as a bit of a symbol of what the run rate of earnings will be for the rest of the year. And so I think you'll see on Monday that some of the annual estimates for JPMorgan will come down as people think about more of a run rate for the rest of the year in the 130 to 140 range, not $1.40 to $1.50. Whereas at Wells Fargo, they Wells reported $1.05, up from $1 in the fourth quarter, and I think estimates will be going up for the remainder of the year at Wells.
Can I jump ahead, David, to next week, because we have Citi reporting and also Bank of America. Both of these banks have legal and other issues for different reasons, and you're recommending both of these companies, both of these banks as well, and tell us why, and what are you expecting in their quarterly numbers?
My estimate for Citi is $1.15. That excludes the most recent mortgage settlement. My estimate for Bank of America is 25 cents. That's a little bit below the consensus. I'm being a little bit more conservative on Bank of America, again, because of some of the trading issues that we saw at JPMorgan. Again, I think over time, the big four banks, Citi, Bank of America, Wells Fargo, and JPMorgan, are slowly but surely going to take market share from smaller banks as they have national scale, a diversity of businesses, and a diversity of risk. I think Citi at the moment is probably the most attractive stock in the group simply because it's trading at about a 20% discount to tangible book value. And I think Citi will, over the course of the year, be able to resolve the capital plan issues that the Fed had a few weeks ago, and Citi will be able to increase both its dividend and its share repurchase activity.
So fundamentally, you do not think Citi's problems are insurmountable. That was going to be my question, but you answered it. But let me turn it another way. Is banking the fun business it used to be, David?
Well, I think a lot of bankers would say that it was never all that much fun. I think today, look, I was at a conference this week with a number of players in a variety of financial businesses, and the one thing that they all said was that their relationships with their regulators are very tense, almost hostile. So I think it is very clear that post the financial crisis, the intensity of regulation, both in terms of laws and in terms of the attitudes of the regulators, has changed. Over time, I think both sides need to spend really more time talking to each other and figuring out how the banks can go forward and provide the credit and other services that the economy needs to grow faster.
All right, so banking is not as much fun as it never was. David Hilder, thank you very much. Senior bank analyst at Drexel Hamilton.
And still ahead on the program, an iconic American industry is having a hard time attracting young workers. The story of what's being done to change that coming up next.
A big development in the ignition switch crisis at General Motors. Internal GM documents released by congressional investigators today revealed an email to GM's current CEO back in 2011 that detailed steering problems in cars that are now being recalled. Phil LeBeau joins us now from Chicago with more on this latest development. How damaging, Phil, are these documents, especially for CEO Mary Barra?
On the surface, it doesn't appear to be a smoking gun document. And in fact, here's the email right here, Tyler. What is interesting is when you look at these emails, it does indicate that there was some discussion about steering issues that were at least emailed to Mary Barra. Now, whether she saw them, didn't respond, did respond, there's no emails from her. But here's what the email says, and it was in response from one engineer outlining an article in the New York Times about steering issues for the Saturn Ion. And in the email, he writes, Mary, during the initial Cobalt case, and again, that may be separate from the current Cobalt case, but he writes, during the initial Cobalt case, the Ion data did not justify being included. This situation has been evolving. We will meet and understand the latest data. Now, this afternoon, General Motors has come out with a response. They tweeted out a response about what Mary Barra may have known. And General Motors says the email to Mary Barra dated on October 3rd of 2011, the one I just read, references a Saturn Ion steering issue, which is completely separate from the ignition-related GM recall. So that is GM's response to this. So, Tyler, look, you're going to have to see a lot more documents to get some perspective in terms of what Mary Barra may have known. But she has made it clear, and they stand by the fact that she has said she did not know about this before January of this year.
All right, Phil, thank you very much. Have a great weekend. A little bit more on General Motors now. A group of U.S. senators urging the Department of Justice to intervene in the recall. The senators are calling on the agency to require GM to establish a victims fund and oppose any action by the automaker to deny responsibility for damages. Shares took a hit today, dropping 4%, 10-month low now, closing below the IPO price for GM of $33 a share.
Well, here's some good news for the bankrupt city of Detroit. A federal judge approved the city's latest attempt to pry itself free from some long-term financial contracts known as interest rate swaps. They've cost the city tens of millions of dollars to UBS and Bank of America's Merrill Lynch unit. The two banks will now be paid $85 million to terminate that deal, which was used to boost municipal pension plans.
President Obama wasted no time in naming his pick to replace the embattled Health and Human Services Secretary Kathleen Sebelius, who took a lot of heat for the botched rollout of the Affordable Care Act's marketplaces. The administration nominated Sylvia Matthews Burwell, who now heads up the White House Budget Office, to be the next Secretary of HHS. President Obama touted Burwell as someone who can handle even the toughest challenges.
Just 4 days until your 2013 taxes are due, but today, President Obama released his family's returns. The Commander-in-Chief and First Lady reported a total income of $481,000. They paid $98,000 in total for taxes, for an effective tax rate of just over 20%. The Obamas donated $59,000 to charity, and they paid $23,000 to Illinois, where they still own a home.
Earlier this week, we told you about the so-called Heartbleed Bug, which caused chaos for some big-name websites, potentially exposing users' data to hackers. Now, the infection has gotten worse, jumping from software to gadgets we use to connect to the internet. Josh Lipton has more now on what this latest development means and what else may be at risk.
It started with Yahoo, OkCupid, and Tumblr. Now it's threatening tech bellwethers and possibly even our banks. It's called Heartbleed, a security flaw in the encryption technology used by millions of websites. That means usernames, passwords, credit cards, and other sensitive information are vulnerable to hackers.
It's almost trivial to exploit. The damage of it is very, very powerful. An attacker can compromise those private cryptographic keys, which basically give them unlimited access to sensitive communication between banks and other companies and their clients. So I think it is extremely dangerous vulnerability out there.
Cisco and Juniper now say some of their networking products are exposed to the Heartbleed bug. This is a real concern since these are the companies that direct data traffic across the internet. But the danger doesn't stop in Silicon Valley. Banks are also potentially exposed to the threat. The question for consumers is how safe it is to continue online banking right now. Smaller banks that don't spend time and money on security, experts say, are a real worry.
They may have one IT person that does all their IT and all their security. They rely on third-party processors to provide security, and that hasn't worked very well.
Analysts say consumers who use small banks for online banking should call the bank, find out if that bank is vulnerable to Heartbleed, and if so, when the bank will address the threat. Once the bank does, consumers should then change their passwords. Heartbleed is a manageable security issue, but each company with potential exposure needs to address the threat, update their software, and alert users who then need to change their passwords. Whether companies can react fast enough is the open question. Josh Lipton, Nightly Business Report, Silicon Valley.
Shares of Zoe's Kitchen skyrocketed in the company's trading debut today, and that's where we begin tonight's Market Focus. The Mediterranean-themed restaurant offered 5.8 million of its shares at $15 each. That was at the upper end of the expected price range. Investors found the new offering appetizing, and the stock surged about, get this, 65% to $24.72. China's largest e-commerce company, Alibaba, has agreed to buy AutoNavi for about $1.5 billion. Alibaba already has a large stake in this mapping and navigation company. Shares of AutoNavi popped on the news, up almost 3% to $20.62. Alibaba isn't a public company in the U.S. just yet. It is expected to make its Wall Street debut later this year.
Shares of Herbalife way down on a Financial Times report that the U.S. Department of Justice and the FBI are investigating the multi-level marketing company. Herbalife has been accused of operating a pyramid scheme by the hedge fund manager Bill Ackman. The company says it has no knowledge of any ongoing investigations and denies the allegations that it is a pyramid scheme. Shares tumbled about 14%, though, to 51.48. And Sony is warning customers to stop using some of its Vio laptops, saying it's possible that the non-removable battery pack could overheat and catch fire. The defective batteries are in Fit 11A devices, 11-A. The Japanese electronics maker says it is in the process of creating a program to repair or replace the products. Despite that, shares of Sony were up more than 1% today in a down day to 1838.
Moving from new economy to old economy, there's a new push by the U.S. government to get more people interested in farming and ranching, especially young people. Jane Wells explains.
For a time, 33-year-old Daniel Sinton left the farm.
I graduated from Stanford in 2002, and most of my friends were going into high tech and things like that, and so I spent a couple years doing that.
But he has returned to the 18,000 acres his family has had for 5 generations in Shandon, California. His father and grandfather were afraid he might not.
Yeah, sure. It's always a concern. Time runs out, and you don't know what's going to happen if somebody doesn't step in, as I did with my dad and as he has now done with me, and he'll have the same worry in 30, 40 years as well.
It's a worry not just here. The average age of the American farmer is 58 and rising.
If you take a look at the numbers of our recent ag census, what you see are that there are hundreds of thousands of farmers who are over the age of 75 and 65, but only tens of thousands of farmers under the age of 35.
The USDA is trying to attract new blood with loan programs and training, but it's a hard row to hoe if you don't already have land in the family.
It's very difficult to make a living in agriculture. It's impossible if you have to buy a ranch.
Ryan Kirby was a petroleum engineer in Houston, but he too has come home to join the family farm in Louisiana.
I absolutely love what I do. I would never do anything else unless I absolutely had to.
In Atlanta, 34-year-old farmer Jake Carter uses agritourism to teach a new generation about farming.
Even what we're doing here, teaching small children, most of the time they're pre-K through 2nd grade, about farming. You can just see the light bulbs in their heads come on, and you know, that may be something they want to do one day.
Farmers may be disappearing, but farms will not. Investors are buying up property like this land near the Sinton family ranch, which will most likely be managed by outsiders who don't live in the community. This could be the American farm of the future, unless a new generation can figure out a way to buy land and make money.
Why do it?
You know, the love of the land, I think it's, you know, it's the right thing to do. It's a wonderful place to be.
For Nightly Business Report, Jane Wells, Shandon, California.
And to read more about what's being done to attract the next generation of farmers, go to our website, nbr.com.
Still ahead, I'll look inside Nike's high-tech lab where it's creating the next generation of golf balls. Can the company really break through in this billion-dollar business?
And finally tonight, it's a huge weekend for golf fans. That's because the 78th annual Masters Golf Tournament is underway in Augusta, Georgia. And with millions tuning in to watch their favorite pros hit the links, we took a little peek into the future of the game. Morgan Brennan has more from Nike's top secret lab that's driving to make a better golf ball.
They call it the Oven West, Nike's standalone R&D lab dedicated solely to golf balls. Here, engineers cook up new prototypes to be used by company-sponsored pro golfers like Tiger Woods and Rory McIlroy, and more importantly, by consumers. New designs are shot from golf ball cannons, even rolled around in the sand for 2 days to see how they weather the elements.
This is the place where up to 40 engineers get together and talk about the next great innovation to make golfers better. So they hatch the ideas, they test the performance of these ideas, and ultimately they bring great products like our new resin golf ball to market.
The resin line started hitting store shelves this year. It has a resin core weighing less than the more traditional rubber, and a waffle-like speed lock shape that its engineers say add more energy to impact. Nike has high hopes for its golf balls, and not just because of sales. But while Nike has dominated golf apparel and footwear, convincing consumers to buy golf balls hasn't been easy.
Golf balls are a $1.2 billion business, and the space is crowded. According to the USGA, more than 1,300 designs were tested in 2013 from 73 different companies. In fact, each year, enough golf balls are produced to circle the entire Earth.
We want to be seen not just as the Nike brand, we want to be seen as a golf equipment company. And it's very difficult, I think, in this industry to be seen as a golf equipment manufacturer per se, unless you've got the full line.
Competitors like Maxfly and Titleist have been around for decades, and golfers tend to be loyal. Not to mention Bridgestone, Adidas TaylorMade, and Callaway. But Titleist owner Acushnet is by far the biggest, claiming an estimated 50% of market share. That's one reason analysts say Nike Golf means little to the larger business.
They reported sales last year in fiscal 13 of $791 million. So it's a nice-sized business overall, but for them it's not, they have a $27 billion business. So it's a good business, but doesn't move the needle very much.
Still, the division is growing, albeit slowly. Nike Golf believes the key to unlocking more market share ultimately lies in innovation, and that comes from the oven. For Nightly Business Report, I'm Morgan Brennan in Beaverton, Oregon.
And that's Nightly Business Report for tonight. I'm Susie Garup. Thanks for watching. Have a great weekend.
I'm Tyler Matheson. Thanks from me as well. Have a great weekend. We will see you on Monday.
Susie Garup with a Nightly Business Report news brief. Wall Street wrapped up a tumultuous week with another meltdown for the major averages. The Dow fell 143 points, closing just above the 16,000 mark. The Nasdaq lost 54 points, closing below the key 4,000 level, and the S&P was down 17 points. Two giant banks out with opposing quarterly earnings news. Profits at JPMorgan tumbled 20% on a slowdown in trading and lending, but profits at rival Wells Fargo surged 14% on strong mortgage business. And a big development in the ignition switch crisis at General Motors. Internal GM documents released by Congress today revealed an email to current CEO Mary Barra detailing the steering problems going back to 2011. Be sure to tune in to Nightly Business Report right here on your public television station.